Hey everyone, welcome back. Today, we're bringing you a brand new explainer tackling a choice you probably make, honestly, almost every single day: debit or credit. We're talking about those two identical looking pieces of plastic sitting in your wallet right now. On the outside, they look like twins, but behind the scenes, they operate in completely different financial universes. So let's figure out exactly how these tools work so you can take total control of your money.
Here's our roadmap for today. 1. Meet the contenders. 2. Daily spending and fees. 3. The long-term impacts. And finally, 4. Picking the right card. All right, let's jump straight into section 1. Meet the contenders, the basic mechanics of two very different cards.
So, debit or credit, what is the actual difference here? At first glance, they look exactly the same. They've both got that long string of numbers, an expiration date, and the little security code on the back, but the way they actually pull the money to pay for your groceries or your gas, it couldn't be more different.
The absolute crucial difference is where the money comes from. A debit card gives you direct access to your own funds currently sitting in your checking account. When you swipe it, boom, the money is instantly pulled out. It is literally just like handing over physical cash right from your pocket. But a credit card, that is borrowing a bank's money up to a set limit that you absolutely have to pay back. You aren't using your own money at all. You're basically writing a temporary IOU to the bank. They cover the store today, and you promise to pay the bank back later.
Moving right along to section 2, daily spending and fees, how each card changes your habits and costs.
Now, financial experts at Ramsey Solutions point out something super interesting. They say when you swipe a credit card, it feels like you're playing around with imaginary money, so it's easier to spend more of it. This is what we call the monopoly money effect. With credit, you don't instantly see your bank account drain, so it kind of feels like a game, right? But that is a sharp contrast to the hard reality of debit. With debit, you know that once your actual money is gone, it is officially gone.
But hey, debit definitely has its own risks. If you aren't tracking your spending, you could get hit with an overdraft fee. This is a penalty charged by your bank when you use a debit card to spend more money than you actually have in your checking account. Like, let's say you only have $50 in the bank, but you swipe your debit card for a $60 pair of shoes. If the bank lets that go through, they're going to slap you with a penalty fee just for accidentally emptying your account. It's a really quick way to lose money if you aren't paying close attention.
On the flip side, credit cards have a massive trap of their own: the interest charge. This is the cost of borrowing money on a credit card, which gets added onto your bill if you don't pay off your entire balance by the end of the month. Remember, it's the bank's money. If you just make that tiny minimum payment they ask for, they are going to charge you a hefty fee for the privilege of continuing to borrow from them.
And just how expensive is that borrowing? Well, take a look at this massive number: 18.43%. According to our sources, that was the average credit card interest rate back in 2022. And honestly, rates can climb way higher than that. This shows exactly why carrying a credit card balance from month to month is so incredibly expensive. If you buy a TV on credit and don't pay it off right away, that interest means you're ultimately paying way, way more than the sticker price you saw in the store.
Okay, let's zoom out a bit for section 3, the long-term impacts, building a future or falling into a trap. When we look at the big picture long-term, debit protects you from high-interest debt, which is amazing for keeping your life debt-free. But because you aren't actually borrowing anything, it does absolutely nothing to build your credit history. Credit cards, over the long term, are a classic double-edged sword. They build a positive credit score if you pay them on time, proving to banks that you're trustworthy. But man, they risk burying you in massive, stressful debt if you ignore them. So how do banks actually measure that trust? It's through a FICO credit score. Take a look at these factors on the chart. Payment history makes up 35%, and the amounts you owe makes up 30%. That means just paying on time and keeping your borrowed debt low makes up almost 2/3 of your entire financial reputation. It is absolutely huge. And why does that score matter in the real world? Well, the benefits of a good credit score are truly life-changing. We're talking easier approval for apartment rentals, qualifying for car loans, actually getting approved for a home mortgage, and even earning awesome cashback and travel rewards. These are major life milestones that are honestly just a lot harder to achieve if you only ever use a debit card. But to keep things totally objective here, those rewards come with serious risks. Let's look at the credit debt trap. Step 1, you make an unexpected purchase you can't really afford. Step 2, you only pay the minimum monthly payment. Step 3, that huge interest rate gets tacked onto your balance. And step 4, you wind up paying far more than the original price. This snowballing debt cycle is exactly how credit cards can seriously drain your wealth.
All right, bringing it all together in Section 4, picking the right card, the final verdict on when to swipe.
So when should you actually pull which card out of your wallet? Well, use debit when you're sticking to a strict budget, avoiding new debt entirely, or withdrawing cash from an ATM. It is your best friend for spending only what you have. But you'll want to use credit when you're shopping online, since it gives you major fraud protection, or when you're booking flights and hotels, or trying to earn those cashback and travel rewards. If you do decide to step into the credit world to build your score, you absolutely must follow these golden rules. First, pay the entire balance in full every single month, no exceptions. Second, keep the amount you borrow under 30% of your limit. Third, always make payments on time. And finally, avoid using credit for super expensive ATM cash advances. If you stick to these rules, you get all the perks without paying a single penny in interest.
The bottom line is this. Both cards are incredibly powerful tools, but your own financial discipline determines whether they build your wealth or drain it. It completely comes down to your daily habits and how responsibly you manage the plastic in your hand.
So, knowing what you know now about instant cash versus borrowed money, the heavy risks of interest, and the awesome rewards of good credit, think about your own financial future. Which card will you swipe at the checkout counter tomorrow? Thank you so much for joining me for this explainer. Keep learning, and we will catch you next time.